Good morning, everyone. It's Stuart Williams speaking. Welcome to our August markets update. First up today, it's a very auspicious day. It's the last day of business for Nico Asset Management. We're transitioning to Amova, as hopefully you can tell from my background. So these are the new colours. As of Monday, we are officially Amova Asset Management New Zealand. Apologies up front for any work this has caused for you or for your clients. I expect you've seen all the critical comms stuff already, but if not, if there's anything we're missing for you, just let us know. A point to keep in mind is that we actually do the website transition on Monday. So if there's something you normally get from the website and it's not available, then hey, just reach out to us directly. Just a little bit of housekeeping. Today is also the final day for registration for the forward lunch, which happens 8th, 9th and 10th of September. For any of the press online, I hope you know the drill by now, but come to us or to Jez if you need quotes or audio or video of this. And a reminder to everyone else online that we are recording this and send it out afterwards as well. So, okay, so on to the introduction. So we're doubling up on fixed interest today. We're delighted to hear from Samuel Grantham from Goldman Sachs Asset Management for the first time. Then that will be followed by our own Fergus McDonald, cash and fixed interest team, and we'll end with Owen Batchelor from the equities team, fresh off the end of earnings season. The final reminder before going to you, Sam, and asking you to introduce yourself is just to remind everyone online that the Q&A function is live. I'll curate the questions if there's time for each speaker, or we'll fill them in afterwards for you, or I might even open them up or do them online. So, Sam, welcome to New Zealand virtually. The floor is yours, and introduce yourself, and Gemma will deal with your slides too. Thank you.
Brilliant. Thanks very much, Stuart, and good morning, everyone. So essentially, my background, I'm acting as a client portfolio manager for GSAM across global fixed income and investment grade credit, based in Singapore. And actually before that, I had about 12 years of investment experience managing investment grade credit, but also multi-sector credit as well. But yeah, very happy to be here, and I'm going to kick off on slide 4, if that's okay, Gemma. Can everyone see the slides? Oh, sorry, I'll be patient. Brilliant, thanks very much.
They're all coming up well.
Fantastic. So in terms of the GSAM platform, this strategy leverages one of the largest global fixed income franchises with investment expertise and research insights in all key geographies and sub-strategies. This is really essential to have scale to run multi-sector fixed income, such as the Global Bond Fund. Really, it ensures you have dedicated teams focusing on various alpha levers across global fixed income markets, whether that's top-down, sector allocation, macro strategies, or actually bottom-up security selection. So you can see on this slide, 1.75 trillion in assets under supervision, 200 billion in multi-sector fixed income. And when we think about global ag, which is really very focused on the global fixed income type strategy, there's about 120 billion in assets under supervision at this point in time. If we move to the next slide, Gemma, please. I'll briefly touch on this slide because it not only really defines how we actively invest, but also how we're resourced and touches on our investment philosophy. But I will be quite brief. So first of all, really important, we take a comprehensive multi-sector view, leveraging our deep expertise across the full fixed income spectrum, hence why it's crucial to have scale. It really drives deeper insights across the various alpha platforms. We assess the macro backdrop with inputs from economists, sector teams, and really here we calibrate risk appetite and we see where we think there's value. This then determines the portfolio's overall risk budget and really the allocation between macro strategies, sector allocation, and security selection. That's decided by our investment portfolio managers, Lindsay Rosner and Simon Dangle. I think what's also really important is we review the portfolio on a continuous basis from a risk perspective to ensure positioning remains consistent with our active investment views. That's the portfolio is appropriately diversified to ensure tail risks are effectively managed as well. Key here is conducting or constructing diversified balanced portfolios, but being dynamic with that positioning. And I'll touch on a few examples as well, ensuring we're taking risks where we have conviction and see value. And look at risk across the entire platform and portfolio and not operating in silos. That's really, really important. Right, so if we kick off on the market review. So this will be on slide 7, please, Gemma. Brilliant. Thank you very much. What we can see on the whole, it's been a positive period for government bond markets, and that's really focusing on the chart on the left-hand side, and that shows total returns across kind of the 3-month, but also the 1-year numbers as well. I guess one exception to that, if you look at the chart in a bit more detail, is Japan. Government bonds, which continue to trade weak given inflation concerns and expectation of further rate hikes, and that really caused government yields to lag other markets. Despite the market volatility in April, actually what we can see now on the right-hand side is actually very strong positive excess returns, i.e. returns above government bonds across spread sectors. Maybe somewhat surprising was also on the whole, high risk or higher beta parts of the market outperforming, such as emerging markets, high yield, but also investment grade corporates generating a good excess return recently and over the 1 year. I think this is in part driven by better than expected tariff negotiations than initially feared, and really a very strong technical support for corporates such as investment grade with strong inflows into the asset class and really strong carry of spread assets given all-in yields versus recent history still remain very compelling. And again, we'll touch on this in a bit more detail. So on the whole, if we think about the market in the last few months and the last year, it's been a very supportive environment for global fixed income markets. But what do we think about the outlook from here? And really, we'll go on to the next slide to discuss that in more detail. So we'll start with the growth picture. On the whole, points to a modest deacceleration. So US growth, we're expecting about 1% by 2025 year end. Clearly, there are risks from tariffs, weaker consumption, more recently, kind of a slowing job growth picture. And whilst you could argue maybe AI-related capex spending remains fairly robust, which could obviously help offset some of those headwinds, we really think underlying growth has clearly slowed compared to I think it was around 2+% seen in 2024. If we think about the euro area, I mean, clearly recently there's been reduced trade uncertainty. There's a fiscal stimulus from Germany, and that's really increasing optimism for growth in the second half of 2025 and 2026. In terms of inflation, despite I'd say regional divergence and potential delays from tariffs in the US, we are seeing progress. And maybe one exception to that is obviously Japan, which we've kind of touched on. And really that's driven by domestic demand imbalances. So from a policy perspective, just looking at the right-hand side of this chart, and really consistent with a steady deacceleration, we are seeing easing across most major economies. Touch on the US in a moment, but resilient euro area and tariff agreements between the US and Europe reduces downside risks to some extent. In the UK, and you can actually see it's slightly lagged, especially on the inflation front. Inflation has been slightly delayed, and that's caused a slight bias to kind of slow the easing, but we do still expect rate cuts to continue there as well. If we look at the bottom chart, this is just showing current policy and kind of policy rates across the globe into 2026. And what you can see on the whole, it's a very supportive environment still for fixed income markets. Supportive central banks, modest growth slowdown, and if needed, central banks ready to kind of step in given where policy rates are today. If we move to the next slide, please, Gemma. Just really going to focus now a bit on the US, and obviously there's been quite a few moving parts recently. So I think we updated the slide quite last minute. But over the weekend, we had obviously Jackson Hole. Powell was firmly on the dovish side, although did not explicitly pre-commit to a September cut. His reference to a shifting balance of risks, clearly for us intended to signal and to the market that a cut may be imminent. This sets us up in our view for a September cut, and I think that's generally market consensus now, and clearly obviously barring any kind of material surprises in the next round of inflation and labour market data. At the same time, however, Powell did not signal a rush to deliver outsized cuts, so we're not expecting kind of 50 basis points, and really reiterated his view that the policy was only modestly restrictive. And I think that's an important point to take out of the meeting. Powell was also quite dovish on the inflation outlook, noting that a reasonable base case was that the effects of tariffs will be relatively short-lived. Which really supports further cuts into 2026 and 2027, which you can see in the dot plot chart on the right-hand side. So again, a further positive for global fixed income markets, we think. In terms of the next slide, please. Thanks, Gemma. So key question is, what does this mean going forward? Where do we see conviction? And really, this slide highlights, despite diverging themes across markets, yields on the whole remain attractive. But really key here is being selective. So at the moment, we're overweight European rates on an outright basis. We actually added to this position recently. We think downside growth risk from tariffs could actually prompt the ECB to cut more than the market currently expects. So that's maybe somewhere where we're pushing against kind of market expectations. In terms of the UK, again, we expect the BOE to maintain its quarterly pace, despite the market pushing back on this, given recent higher inflation data. Japan yields, obviously, you can see kind of really the outlier here, but we really don't think they reflect domestic fundamentals. Economic data there, again, remains really quite robust, and inflation pressures will likely continue to build there as well. So that's actually one of our key underweights there on a directional and a cross-market basis, and one of the key trades at the moment. You can see on the right-hand side, this is lifted intermediate to long-end maturities via high term premia, investors demanding essentially high yields to go further out the curve, and reduce conviction in deep cutting cycles, given the data's been holding up in general pretty okay. So steepening 2s10s as a result, which you can see on the right-hand side. We really expect this theme to continue in the short term, in a position for further curve steepening across the US, Europe, and Canada, as well as a flattening bias in Japan. I think also what's quite interesting in the last week, obviously we've had news flow around Fed independence. So that's another kind of theme emerging. And we think in general, this causes the curves to further steepen, kind of potentially pricing in more aggressive cuts in the short term, but actually concerns around inflation in the longer term. If we turn to the next slide, please, Gemma. I think when we think about spread sectors, such as investment grade credit, market really starting to look quite compressed. And actually, when we think about it on a spread basis, which is on the left-hand side, you can see actually trading from a historical perspective at very tight levels. Why is that the case? I mean, it's really been driven by a number of things. First of all, a very strong demand for high carry type assets. So we've seen a very large flow picture being very supportive of credit markets. Corporate earnings actually have been holding up okay, pretty decent actually. And actually, when we think about credit metrics and credit fundamentals, actually again been pretty strong. You can see actually on the right hand side though, when we think about yields, actually still very attractive. So 4.5% for global credit from a yield perspective. So again, really reinforcing that high quality carry in the current environment is probably a good way to generate a return. Clearly, if we do see a weakening in the growth picture, investment grade credit would underperform that. And so really, despite very attractive yields and good performance year to date, we've actually been looking at rotating some of that investment grade credit risk into other areas of spread sectors. Slide 12 really shows why. This looks at the relationship between investment grade corporate spreads versus MBS spreads. And what we can see, actually, when it's in the top left, investment grade looks quite cheap on a risk adjusted basis, whilst the bottom right really start to think that actually we should be rotating into some higher quality RMBS type assets. So we've been leaning into securitized, predominantly agency RMBS, and really kind of reinforcing the point that we want to be dynamic with our spread sector allocation. Again, still think a very good environment for spread and carry assets given all in yields, but certain areas are now looking a little bit expensive on a risk adjusted basis. We really want the ability to add back if we see more weakness in credit, given long term, still think very attractive in the current environment, given yields and the duration benefit of credit. So that's kind of gone through the market outlook in terms of, and really kind of highlighting some of the key positioning. We'll just do a quick reminder of the strategy. So actively managed against the Barclays Global Ag Index, hedged in New Zealand dollars. Actually, if we move to the next slide, please, Gemma. We've been running the strategy for over 10 years now. And over a market cycle, we expect the portfolio to deliver around 100 basis points per annum of alpha, with a tracking error in the range of 100 to 150 basis points. The portfolio deploys kind of three key alpha levers across top-down macro strategies, so excluding currency, but that's macro and sector allocation, and then bottom-up that security selection process. And from a credit quality perspective, it's investment grade only. And if we move to slide 15, please, Gemma, I'll just touch on performance. Thank you very much. So in terms of performance year to date, as of July, on a gross basis, we're 34 basis points ahead of benchmark. As of last week, continues to build on that. So August has actually been a positive month for the strategy, and we're now close to 48 basis points ahead for the year. You can see the 1 year numbers below target, but actually the 2 and 3 year numbers remain compelling. And really the 5 year numbers, again, slightly below target. But actually, when we think about 2022 as a period for fixed income, it was probably one of the most challenging. Really nowhere to hide except cash. But the shorter term numbers are encouraging, and again, the long term numbers are still very supportive. In terms of some of the high level drivers from performance year to date, a good contribution from being underweight Japanese rates. And again, I've touched on that theme a few times, but also actually a good contribution from being long other G10 regions, such as the Eurozone and Sweden. From a cross-sector perspective, also positive driven by contribution from securitized credit. We've been quite overweight there. And again, we'll kind of summarize that in positioning in a few slides' time. In terms of detractors, emerging market local currency, that definitely lagged in particular, and underweight to China government bonds. Although recently, actually in August, that part of the market's actually lagged quite a bit, reduced expectation of policy easing in the region. So performance has come back a bit there. And I guess maybe a final point was on the continued curve steepening, and we've really been positioned for that across most markets. If we move to the final few slides, thanks very much, Gemma. So we've kind of touched on some of the high level themes. This slide's a really good overview of where we have conviction and where we're more cautious. On a duration basis, you can see slightly underweight, mainly driven by Japan, and the top right really shows down that country allocation and from a duration perspective. So the Japan underweight, obviously quite material. US slightly underweight, but then kind of most other markets were actually quite long, except Australia, obviously. Unlike the Fed, which we think has to balance upside risk to inflation with downside risk to growth, and the labor market, the tariff shock generally elsewhere reinforces disinflation and downside growth risks and dovish central bank action, and that's really why we have conviction in duration in other regions. From a spread sector perspective, you can see about 74 basis points OAS versus the benchmark at about 32 basis points. So we're still very much kind of overweight spread assets. And really that's driven by a combination of things, driven by the fact that we're slightly underweight government bonds, which you can see in the bottom left on a market value perspective, but also we're overweight some of the high quality securitized credit that I mentioned. So we're overweight ABS, we like CMBS, and we've recently been adding to our RMBS position. You can see investment grade on a PV basis, still slightly overweight. But actually, another metric that we look at from a risk perspective is a beta adjusted spread duration. And in that metric, we are now actually underweight investment grade corporates in this strategy, recently been dialing that down. And that's really driven by two themes. The first is that, again, we want room to add if we see a bit of weakness in the growth picture. And the second theme is actually we see much more value in the short end of the credit market because curves remain very flat. And so that naturally reduces the spread duration. And then on the right-hand side, you can see from a rating perspective, really quite up in quality at this point. And so even though the average rating versus the benchmark is similar, kind of at A+, you can see we still like triple Bs in some areas, but then elsewhere we're kind of overweight through securitized and government bond quality. I think the final point before moving to the next slide is you can see generating an extra 35 basis points of yield versus the benchmark, and really reinforces that carry element of our positioning. Next slide, please, Gemma. Thanks very much. I think we like this slide because it really kind of high level kind of shows where we have conviction across the macro and the credit conviction piece. Given growing dispersion across interest rate markets and actually on the curve front as well, we do think we're seeing more opportunities in the macro strategy to generate alpha in the current environment. Again, key is being selective, but ultimately think it's a very good backdrop for fixed income markets. Central banks easing will cut more aggressively if we see a more severe downturn. In the US, for example, we could easily see the Fed cutting kind of 200 plus basis points if there was severe deterioration in the credit picture. Inflationary effects from tariffs, again, expected to be quite temporary, which again is very supportive for gradual central bank easing, but also not a complete severe slowdown in growth. So on the whole, we think the business cycle has been extended, hence still happy to own some spread assets given the attractive carry and all-in yields. But again, a very compelling picture, we think, for kind of global fixed income markets at this point. So I'll stop there and kind of hand back to you, Stuart, in case there's any questions.
Awesome. Thank you very much. That's really comprehensive. I guess I was just thinking about the US a bit, and agree with your sort of summation about they've got powder dry and all the rest of it, which is sort of I mean, maybe we should expect this from President Trump. The ongoing stoush with the Fed. Could you make any comment on that? I mean, it's trying to influence the long-term nature of the governors has is the sort of thing that you shouldn't really have to contemplate as a fixed interest manager. But what's your view on that on those sorts of actions?
Yep, no, super relevant, and again, it's been in the headlines quite a bit. And actually, we've already talked about potential implications across the interest rate market in terms of that continued curve steepening and being positioned for that. But I think even with the majority of Trump appointees on the Fed board of governors, it's far from guaranteed that the White House would be able to engineer a successful dovish takeover. I think that's probably our main takeaway. It's still, this is a risk that will have to be priced by the market, and to that extent, Cook's removal moves us closer to that outcome. It's not unreasonable for the market to build in some risk premium. But yeah, it's something we're obviously watching very closely. I think there was headlines last night that they were going to kind of challenge that decision. But yeah, it's definitely having an implication on markets, and therefore we do have to consider it quite carefully.
Yeah, I guess the other one that had caught my attention, thank you for that as well, was the French, in a very unusual and un-French-like way, look like they're trying to be very responsible and balance the books, and even disturbing their own holidays to contemplate that. I mean, do you see that sort of I guess fiscal responsibility starting to broaden in Europe, for example?
Yeah, I mean, it's really quite interesting because obviously we almost had an exact repeat of this the year before. I mean, we obviously don't tend to have political views, but actually when we think about some of the positioning in the strategy at the moment, and actually there's two ways to think about it. From an investment grade kind of credit risk perspective, we were actually underweight French banks, which are probably the most impacted part of the market given the recent news flow. Why were we underweight? We think you need a certain type of risk premium to be owning certain kind of country of risk banks. So French banks in general were starting to price actually through European banks in general, or German banks, which is what we tend to use as a proxy. And so given they've now traded kind of more expensive, we actually went underweight recently. And since then, you've obviously seen that underperform. We probably need to see a bit more widening to go neutral. But it shows that we've been more cautious in certain parts of the market. And actually on a duration basis, we're also underweight France. So I think, indirectly, we've obviously been a bit more cautious on the outlook there. But it's something that we're watching very closely. I think the current spread on the 10-year French-German spread is about 82 basis points. And I think last year, so it was actually in December, wasn't it? I think it got about close to 88 basis points. So just before Barnier government fell. So we're getting close to that point again, and something we're watching quite closely.
Yeah, and appreciate you're new to our mandate, but have you got to the point yet where you're starting to have any particular thoughts about New Zealand and Australia from afar? We always find like we are deep in our own sort of domestic or semi-domestic, if you think about Australian views. But I guess the observation we'd make is that perhaps Australia is slowing down a little bit, and New Zealand is probably poised to go a little bit better, and Ferg will probably pick up this point following you. But have you developed any views or insights that you could share on, I guess more particularly on Australia as it relates to portfolio or how it signals for the portfolio?
Yeah, I mean, in terms of our positioning, actually, we're slightly long New Zealand rates versus Australia. So it's quite an interesting dynamic because obviously, I mean, we're just focusing on New Zealand for a second. I mean, obviously, it was quite a dovish meeting from the RBNZ.
Yep.
I think it caught the market definitely off guard. I think our view is just on Kiwi at the moment. I think actually a lot of it's now currently priced. Obviously, seen quite strong performance year to date from that market. And actually, our investment teams are starting to say that some of the kind of the high frequency indicating data improving in Q3 and Q2 GDP potentially actually less weak than the bank expects. So much of the value being there kind of already realized at this point. So actually, relative to Australia, where we're not seeing that kind of potential improvement at this point, which again is probably why we're a bit more cautious in certain parts of that market. Yeah, I mean, again, I need to probably spend a bit more time, and I'll make sure I'm more prepared next time, definitely.
No, that's a good answer, and actually, it's a wonderful segue to our colleague Fergus McDonald. So, Samuel, thank you very much for being available. I was just doing maths in my mind. It's a little bit early in Singapore, so thanks for that, and we look forward to hosting you out in New Zealand when schedules allow. So, thanks very much, and we will see you next time.
Brilliant. Thank you very much, Stuart.
Excellent. Okay, so I think we're moving on to Fergus McDonald next. So hopefully his screen will light up in a moment, and we will be away. All right, Ferg, the floor is yours. There's a lot to talk about. There's a bit of a lead from the international team or from Goldman's there, and we've had Reserve Bank and everything else. So the floor is yours, Ferg. Thanks.
Thanks, Stu. Yeah, I'm the second half of the fixed income tag team for today's talk. I'm going to focus on a little bit of the monthly performance to date. Going to then move on to perhaps talk a little bit about what the Reserve Bank sprung on us at their August monthly policy statement, how we're seeing the economy evolve over this next year to 18 months, which is importantly the kind of time frame that we kind of work to, when we are putting together portfolios. We're not short-term investors. We do look at that medium term and how markets evolve, how monetary policy cycles evolve, how economies evolve in general over the medium term. And also, since Sam just touched on New Zealand, RBNZ, I thought I might just have a quick talk about how we're kind of viewing the kind of Fed as well, because the Fed is actually pretty important for New Zealand, but also sets the scene for interest rates right around the globe. So let's move on. First on the month to date, it's been a strong month for fixed income. The Reserve Bank's dovish moves in August monetary policy statement gave the market a bit of a G-up, and we've seen interest rates both in the shorter term rates and right across the curve coming down. That's seen the composite benchmark, Bloomberg composite benchmark, which we, at least our New Zealand Bond Fund uses the benchmark, is up 1.2% month to date. The corporate index, which is a shorter duration index, is up 108 basis points. And our portfolios, which are still long duration, on the expectation that the extra yield associated with steep yield curves will benefit the portfolios, around 15 to 20 points higher than benchmark. So it's been a good August. I'd like to say that we fully anticipated what the Reserve Bank was going to do with its forward projections. We didn't, but it just kind of reinforces our thoughts and processes that if we're looking at the medium term, the 1 to 8 year to 18 months, that if we get the portfolios positioned in the right direction, the magnitude will determine our level of our performance. But we were positioned for lower rates, and we've seen that through the performance coming through. I might just kind of turn, while we're talking about markets in general, we have just this week seen the ASB return to our market. They issued a 5-year senior bond. They had over $1.5 billion worth of bids for that line. They issued $1.2 billion. which is a record for a credit issuance in New Zealand. And it just shows that the New Zealand debt capital markets are alive and willing to provide high levels of capital to well-rated and well-run companies. So that's kind of a nice kind of, I guess, pat on the back for New Zealand debt capital markets. There is plenty of money looking for a home. I guess the slight kind of negative side is that's one of the reasons why there's been a lot of money on the sidelines, is that there hasn't been actually that much in the way of issuance in New Zealand. But also, perhaps that is also a two-edged sword, in that we have seen credit margins coming down right around the world, and some New Zealand issuers have taken advantage of the fact that credit margins are actually lower in offshore markets than they are in New Zealand. So therefore, investors in credit in New Zealand are being well rewarded over and above what they could get for similar credits in offshore markets. So that's actually quite a positive recommendation for investment in our home market. With having said that, I might just kind of turn to the Reserve Bank and perhaps our outlook for growth. Over the next year to 18 months, as I said, that's the kind of time frame that we really kind of focus upon. Now, it's been pretty obvious economically that New Zealand has been under duress. It's been economic hard times, and New Zealand's economy has needed lower interest rates. And remember, the lower interest rates continues to be the biggest lever that authorities can wield to actually speed up or slow down the economy. And so we think that the Reserve Bank has finally come to that realization that inflation is not quite beaten, but because of the spare capacity in the economy, and that spare capacity is just kind of economic terms for how much can the economy grow before it will be kind of will bring forward inflation and inflation expectations. The Reserve Bank thinks that output gap is so large that they can have more stimulatory conditions, allow the economy hopefully to run hot for a while, and it won't have inflationary implications. And so, the Reserve Bank came to those conclusions in the August meeting. They've been talking about spare capacity for some time, of course, and they gave the market what the market was expecting, a 0.25% drop in the OCR, but importantly gave a strong indication that the OCR will fall to 2.5% by the end of this year. And November is the last monetary policy statement for the year on the 26th of November. And so we're expecting that by that time, the cash rate will be at 2.5%. Because interest rates have now fallen very quickly, very much likely fallen from 5.5% August last year to 2.5%. So 300 basis point movement, and probably when it occurs a little bit over a year, we believe that that movement down in interest rates alone would be enough to engender an economic recovery. And remember, the Reserve Bank and other commentators have been very vocal in the fact that the impact of monetary policy hasn't flown through to mortgage markets yet. Likely to probably fully flow through by the end of this year as well. So 2026 is shaping up to be a year which will have the full impact of that 300 basis point fall in rates. And so we haven't actually seen that yet. But add to that the indications that next year will continue to be a very strong income level for dairy farmers. The dairy farmers have been faced with higher input costs, but they're top line revenue has been very strong, and they've used that to perhaps repay a little bit of debt. But if the income levels remain high, they'll be spending it next year. And to help spend it, the government has got some tax benefits for investment, and I think the farmers will be using those quite a bit. And it's not just farmers. Kiwi fruit growers have probably got even bigger smiles on their faces than dairy farmers. Add to that, sheep and beef are doing still very well. There is strong demand for most of our export sectors, irrespective of tariffs from the US. Tariffs will change trading patterns, and ultimately, it seems to us that the US will be the last place that you will export to. Because it will be more, your incomes will be less if you export to the US. So exporters will be looking for all other avenues to export to, and we think they will be successful, certainly in the kind of in the beef and sheep meat side, and probably dairy and horticulture. So if we're looking at that, we think that growth is going to be quite strong. If you kind of then throw into the mix higher infrastructure spend, the government keeps on talking a big story about infrastructure spend. It is happening, but it is happening quite slowly, as is the New Zealand way. But there is scheduled spending over multiple years. And from a New Zealand perspective, we think it's very important that there is bipartisan support between Labour and National on infrastructure spend and other items for that matter. And we are starting to see a little bit more of that too. So that's actually quite a positive outcome. Easing of migration restrictions, to meet, to have migration criteria eased up will be positive, as will easing the ability for international students to come to New Zealand, tourism initiatives. So everything's kind of working in that general direction. So we can kind of see momentum kind of building in 2026. And if we get the combination of all of those things happening all at once, and a lot of those are just little kind of incremental things that I'm talking about, but if those incremental things all come together, you can see that 26 could be, and perhaps back end of 26 could be quite strong. And the growth side of things, there is one big caveat to that, and I'm not talking about kind of global growth and the like. I'm talking about the prospect of a very close election in October-ish next year. Now, this isn't a political statement whatsoever, but I think that what you will find is that the two big areas of difference between the two main parties will be in the area of taxation, i.e. kind of wealth tax, which will potentially stymie a kind of a little bit of a recovery in the housing market. And the housing market is very important for retail confidence. And the other thing will be electioneering will occur on the reintroduction of pay equity. And pay equity, forgetting about whether it's a good idea, bad idea, kind of economically and for the bond market, where the rubber hits the road is that unless the government gets a whole big lump of money into its coffers, which is unlikely at this stage, all of that money for the settlement of pay equity will need to be borrowed. The conservative cost of that is around about $13 to $14 billion. So that unless there's extra revenue or extra taxes brought in, that will increase the amount of the debt issuance, push out from 2028 the timing for fiscal balance within New Zealand, and the credit rating agencies, which also look at New Zealand's twin deficits, excuse me, the fiscal deficit, which is the main one, they want to see a path to balance, and that will be pushed out at least another 1 or 2 years, and that may have credit rating consequences for New Zealand's AAA New Zealand dollar borrowing. So that is just a little bit of a concern, but maybe not a concern just straight away. I will just say that we have for some time been thinking not necessarily about how low the cash rate is going to go, but how low it will stay and how long it'll stay low for. Our thinking that is that at least 1 year, but we think that now that we've got rates lower than expected and earlier than expected, the recovery can be expected to be earlier as well. So even if the RBNZ is not forecasting a push up in the cash rate until the end of 2026, we believe that perhaps markets will anticipate that occurring and perhaps push up rates by the end of 2026 into 2027. So I might just kind of turn a little bit to the US. And as most of you on this call will know, the US Treasuries, especially the 10-year Treasury yield, is important in establishing New Zealand 10-year rates. We very rarely trade through US, and we have a high correlation of around about 0.8 to movements in US Treasury. So what happens in that Treasury market is important for New Zealand, and therefore important for the shape of the New Zealand yield curve. Excuse me. So from our perspective, and I know that Sam kind of touched on it a wee bit, but we see that Donald Trump's attack on the Fed is unhelpful, but may indeed kind of backfire in his desire to get interest rates lower in the US. Treasury does tend to, the US Treasury does tend to issue longer bonds, and that may just kind of uncertainty about Fed independence and the like may just hold up longer term interest rates in the US. 10-year treasuries in the US are used to price mortgages, business loans, other debts. So to the extent that they stay high, it may just impinge upon economic kind of growth rates and what have you in the US as well. And of course, the bond market, longer end of the bond market, continues to be concerned about tax revenues, deficits in the states, whether the big beautiful bill will actually be a positive or negative for the amount of borrowing that needs to occur. So all of those efforts, we believe, will keep bond markets a little bit on edge. There'll be a higher risk premium involved, and to the extent that US rates continue to be high, or longer term rates continue to be high, that probably means that will limit the extent that New Zealand rates can fall. From our perspective, that's not necessarily a bad thing, because we believe that because of this, we've got a very, very steep yield curve in New Zealand. We've got a 10-year government bond, a little bit below 4.5%. It does bounce around, but if we've got a cash rate heading towards 2.5% and like to stay there for a year or so, that extra yield associated with having a bit of extra duration in the portfolios, we believe is quite helpful, and we believe will be the cornerstone to a good performance for bonds going forward. Now, I know I've pretty much used up my time, and maybe not too much time for questions, but I'll hand it back to you, Stu.
Hey, thanks very much, Ferg. very comprehensive. Yeah, quite interesting, isn't it? This the time that we're in now, and I think the point that really resonated with me is, potentially that speed to recovery, and maybe moving back in the other direction, coming forward a bit, which of course they don't want to say. I haven't got a question for you specifically, and we'll put that down to the comprehensive nature of what you've told us, and the double shot of fixed interest today, which is probably always the way it should be, I reckon.
Thank you. Thanks, everybody.
Right. We'll shoot straight over to Owen on the back of earnings season. So, Owen, the floor's yours. Thanks.
Let me just share my screen here. Perfect. Okay. So yeah, it's been a very, very busy August for the equities team. We had 28 New Zealand companies report FY25 results over August, as well as a few of our Australian holdings. So I thought I would give a quick rundown on some of the key results, primarily focusing on the large caps in the New Zealand market. But I'll also talk to a few other stocks that announced some sort of interesting or notable news alongside the result. But before I do, I thought I would just show this chart here, which shows the movement of each stock on the result day relative to the NZX 50. So this highlights, which results or which guidance for next year were better or worse than their market expectations. And look, the key takeaway here is that 20 of the 28 results saw price moves on the day relative to the market of less than 2%, which generally suggests most results were in line, with only a few being materially better than expected, and one being EBOS, which I'm sure you can see there being materially worse than expected, and I'll touch on EBOS shortly. But if we kick off with the gentailers, so we had all four of them report largely inline results, which is almost always the case for these guys as they report monthly or quarterly operating stats. So the market gets a pretty good idea of how they're tracking. And look, it was a really challenging 12 months for the sector, with two severe dry periods during the year, made worse by reduced gas availability. So look, this chart here shows the EBITDA for each of the gentailers from FY18 through to the most recent result, FY25. And then I've also included the next 3 years of forecasts, which are those stripy bars there. And I've really shown this to highlight the significant impact the dry conditions had on earnings for the hydro-focused generators, especially on Meridian in the blue there. As you can see, its EBITDA was down 300 million, or 32%, making it the lowest EBITDA result in a decade. Looking forward to next year, and in terms of guidance, Meridian doesn't provide earnings guidance, but you can see the market expects a very strong bounce back in EBITDA, lifting almost 80%. And the same thing with Mercury. And that simply reflects that, a return to more normalized levels of hydro generation. Contact guidance was in line with consensus, whereas Genesis's was a little disappointing, and it's the only retailer expecting lower EBITDA next year, and that's largely due to some big one-off costs related to its IT investment. But in terms of other updates provided by the gentailers alongside the results, we had Contact, its integration of Manawa Energy is going well. All the previously outlined benefits and synergies are on track. It also confirmed its intention to increase its dividend over the coming years. So dividends are expected to grow 2.5% in FY26 and between 2.5% and 5% in FY27. In terms of Mercury, no real major news announced, given they held an investor day a few months ago, but they did reconfirm that they're on track with their cost out program. So Mercury is looking to hold its OPEX completely flat for the next 3 years, which, look, in our view, is pretty impressive, just given the amount of activity and development going on in that business. It also guided to its 18th consecutive year of dividend increases. There aren't many companies on the NZX that have managed to consecutively grow dividends for that long. On to Meridian, really the only notable update there was that the board has allowed itself some more scope to consider reducing the dividend should we see another, severe drought, so, another 1 in 90-year drought, just to provide the balance sheet with a bit more protection if needed. Now, Genesis, it upgraded its medium-term FY28 EBITDAF target to from mid 500 million to mid to high 500 million, which is positive, and that was due partly to the new Huntly firming options signed recently with this sector, but also due to a pulling forward of its IT spend. We move on to Auckland Airport. So look, no real surprises in the FY25 result itself, although guidance for next year was about 7% below consensus at the sort of key underlying NPAT line. And that's due to the post-COVID passenger recovery struggling on the back of continued capacity constraints in both the international and domestic airline markets. So Air New Zealand continues to be impacted by its engine and fleet issues, and international capacity is proving difficult to attract back to the country as international carriers prioritising high-yielding routes over those to New Zealand. And you can see the impact here on this slide, which shows the number of passengers through Auckland Airport has only recovered to about 90% of pre-COVID levels, and they've been pretty much flat at that level since August 2023, so essentially 2 years. Looking forward, unfortunately, the outlook isn't much better. Management expects 2% growth in domestic passengers and 3% growth in international passengers in FY26, which is both are below historic growth rates, and they don't expect a full recovery back to pre-COVID levels until FY28, which is almost 3 years away. Look, I should say overall, the airport is it is a quality infrastructure exposure, and we see it as largely fair value at current levels. But until the passenger recovery picks up, we don't think it's likely to see any material re-rate outside of its recent trading range. Now, without a doubt, the most eventful result of the season was EBOS, particularly from a share price perspective. It was a bit of a shocker for the market. It was the guidance into next year that really disappointed the market. So EBITDA guidance was about 6% below market consensus, but NPAT was 20% below consensus. And that's really on the back of three things. So firstly, a very competitive environment in the community pharmacy space, which is impacting growth rates and margins. Community pharmacy represents about 40% of EBOS's gross operating revenue, so a pretty decent chunk of the business. The second driver is in the animal care business, where consumers are reducing their discretionary spend on their pets given the tough economic backdrop. And then thirdly, EBOS expects much higher interest and depreciation expense into FY26 as a result of some capex spending on a distribution centre expansion, and that increase wasn't actually being factored into market forecasts. So as you can see on the slide here, the stock got absolutely hammered on Wednesday. It was down 14% on the result day. And I saw a headline that flashed across Bloomberg that said it was EBOS's largest one-day drop in 33 years, since April 3rd, 1992. Pleasingly, we were on the right side of this with an underweight position across our funds, and I'm pleased to say that some on the ground, out in the field research in Australia by Michael de Cesare alerted us to the fact that the competitive environment within that community pharmacy area was actually more intense than we had initially believed. And this was, a key contributor to our decision to move underweight a few months ago. On to A2 Milk. So look, the result itself was a strong performance, albeit in line with market expectations. And actually the result was overshadowed by A2 Milk announcing the acquisition of Yashili's manufacturing facility in Pokeno, as well as the divestment of the Mataura Valley Milk business. Now, these are, in our view, very logical transactions for A2 Milk, primarily because the acquired Yashili facility holds China label product licenses, whereas the divested Mataura Valley business doesn't. It also allows A2 Milk to capture margin on its English label product, which is currently manufactured by Synlait. Overall, though, no change to our view on A2 Milk. We continue to think the company is executing very well in a challenging Chinese market. However, our positioning, reflects the fact that the stock's up almost 70% year to date. as well as our view that we're likely to see a resumption of the long-term trend in declining birth rates in China in 2025. After, as you can see on that chart on the right, a sort of a one-off lift in 2024 during the year of the dragon. Into Spark. So look, the result and guidance for next year we're both in line with market expectations, so not much to see here on that front, although Spark did make a few positive announcements alongside its result. The first one was that it reset or right-sized its dividends to a more sustainable level. So the dividend will reduce from 25 cents in FY25 to about 16 to 17 cents in FY26. Now, this is actually a positive move as it more closely aligns dividends with underlying cash flows. And the second one was that it disclosed a targeted return on invested capital of about 10 to 13%, which compares very favourably to the 8.7% it achieved in FY25. Now, these two announcements continue the string of positive announcements or catalysts that we saw into the run into the result, those being the recent board refresh and the introduction of a capital partner into its data centre business. Now, we think each of these factors or initiatives, I suppose, should continue to support a recovery in the Spark share price, which, as you can see on this chart, has already re-rated about 30% from its lows in March this year. Also worth mentioning SkyCity. It's not one of the larger names in the index, but it was one of the more interesting results as it announced a $240 million equity raise alongside its result. Now, the result itself was ultimately in line with company guidance, although guidance for next year was about 14% below consensus on the back of higher than expected costs at NZICC, as well as lower revenue from mandatory carded play. Now, in terms of the equity raise, the company had planned actually to recycle assets, but ultimately it couldn't execute on those sales in a timely manner, and the proximity to banking covenants and its desire to retain its S&P credit rating meant that it decided to raise equity. Now, the raise was done at a deep 30% discount to the last price, and while this is never the preferred option, it will provide SkyCity with some breathing room against its banking covenants, and it means it won't be a forced seller of assets, which is never a good thing. Looking forward into FY26, we think that should be a trough year for earnings, with a recovery in 27 as the economy recovers and as SkyCity has a full year of earnings contribution from the convention centre. Quickly on Sky TV, look, again, not one of the large caps, but it's worth mentioning as alongside the result, it announced the re-signing of the New Zealand rugby rights for another 5-year period, which is important for the company and a milestone that the market has been waiting for a while. So we see this as a great outcome for Sky. We see annual costs of the deal of about 80 to 90 million, which is about a $25 million saving compared to the costs under the current deal. The other positive for us was the confirmation that the dividend for FY26 will be at least 30 cents per share, which is an increase of 36% year on year, and that follows a 16% increase the year prior. And that 30-cent dividend for next year represents a very attractive cash dividend of 10%. We remain overweight Sky TV. It's been a really solid performer for us, with the stock up about 20% year to date versus the market down 2%. Also, in the midst of reporting season, we had Fisher & Paykel Healthcare hold its annual meeting where it reconfirmed its FY26 earnings guidance, and it also provided first half 26 guidance, which was for NPAT of 200 million. Now, we think this places the company in a really good position to hit the midpoint of its full year guidance. That said, we are conscious that the second half will be impacted by a larger tariff impact than the company expected when it first set its guidance in May. And that's largely a result of the tariff in NZ lifting from 10% to 15% in late July. Now, these charts here simply just show Fisher & Paykel's track record when it comes to earnings. And as you can see, whether you look at either end of the P&L, it's very impressive, and consensus earnings has growth continuing strongly over the next few years as well. Lastly, just to finish off, in terms of performance of the funds over the month, so the NZX 50 is essentially flat for the month. It's up just about 0.5%, excluding the last day today. The core funds in line with the index. Our SRI fund is about 20 basis points ahead, and our concentrated fund is about 1% ahead month to date. It's been another good month for the property sector, with the index up about 2.2% over the month. The property fund, which is the fund I run, is about 30 basis points ahead of that. Right, looks like it's bang on time, so I will hand back to Stu.
Thanks very much, Owen. I think we've got time for a quick question. So you were talking about healthcare, the slide that you're on now. So some of their products are tariffed and some aren't. Is that correct? And can you just explain how that comes to pass?
Yeah, so essentially with FBH, goods produced in Mexico that get exported to the US, they're covered under the USMCA, or the US Mexico Canada Agreement, which is a free trade agreement between those three countries. And then goods that treat obstructive sleep apnea, exported to the US from anywhere in the world, are covered under something called the Nairobi Protocol, which has been in place for quite some time, and FPH's Fish and Paykel's key competitor, ResMed, uses that. And that effectively classifies people with sleep apnea as disabled. So effectively no tariffs apply to that part of Fish and Paykel's product base. The only part of Fish and Paykel's product set that is actually subject to tariffs is the hospital goods exported to New Zealand, exported from New Zealand, sorry, into the States. So, that stock, when the tariff news came out, we initially thought it was going to be very heavily impacted. It turns out only a portion of its products will be impacted.
Awesome. Thank you very much. All right. Also, just to round it out, thank you everyone online for joining us. As a reminder, it is recorded if your colleagues want to watch it, and we can send it out. And we will see you all in September, when we will be Amova Asset Management. Thanks for your support and have a brilliant rest of your day. Bye.